Welcome to the Real Estate Wealth Podcast, where we explore real estate as the most proven way to financial freedom. Join us for insights with leading experts and discover how vibrant health and an abundance mindset are the keys to true wealth. Today, I have the privilege of speaking with Jeff Adler. Jeff is an esteemed industry veteran, currently vice president at Yardi Matrix. With over 30 years in the real estate industry, Jeff has been instrumental in providing market intelligence across various asset classes, including multifamily and the build-to-rent sectors. His extensive experience and leadership roles have positioned him as a thought leader in the field. Jeff holds degrees from Yale, as well as the Wharton School, and is a board member of the National Multifamily Housing Council, as well as chair of the Urban Land Institute Multifamily Silver Council. Jeff is also a lecturer at Harvard University. Jeff, welcome to the Real Estate Wealth Podcast.
Oh, thank you very much. Glad to be here.
Did I miss anything?
That's
you want
enough.
to tell us about? Okay, very good. Well, listen, we're going to have a discussion today about workforce housing, which is near and dear to my heart. And I think yours as well.
Absolutely.
And I appreciate everything you guys do at Yardi Matrix, by the way. I think I told you when I saw you at that conference recently, I'm guilty of using your stuff a lot for, my newsletters, investor reports, and it's really helpful and great data. So I do appreciate everything you do over there. But let's talk about workforce housing today, or I guess attainable housing. Is that the new kind of buzzword?
Whatever.
Are we getting away from workforce?
I don't know. There's too many acronyms.
That's true. But, it's a crucial asset class, as you know, especially as affordability issues are cropping up across the country more and more, depending on where you live.
Yeah.
So let's talk about kind of the landscape of where you see workforce housing today, and kind of, compared to, you've been doing this for a long time. I mean, where do you think we are today?
Well, look, it really is grounded fundamentally, right, in a shortage of housing writ large in the United States, right? Coming out of the GFC, and really, honestly, since the end of the 1986 tax credit deduction for the creation of housing, we've seen a reduction in the production of multifamily housing down to around the 300,000 unit level for a very long time, right? In addition, there is the amount of new supply that can enter the market, and the price point at which that new supply can enter has been just ramped up because of inherent difficulties in the zoning and approval process for new projects, pushing up the cost of what can be delivered to the sort of very ultra high price point, okay? And it takes massive amounts of new supply, as we're seeing in a few markets right now, to sort of compress that. But it's really episodic and will pass. But the fundamental problem is the U.S., and again, it has happened at different cities at different points, has not been producing enough housing at the right price point. And that's what we've seen, sort of the general uptick in rents relative to incomes. And that is creating, problems of affordability, which is why, kind of workforce attainable housing is really that kind of like B and C asset type with a tremendous amount of need and an inability, because of government regulation, I have to be honest with you, to respond to that need gradually over time. So now we've built up this deficit, and then it's been turbocharged because of COVID and its after effects. And so that really is the problem. Now, as an investor, this is an amazingly insulated sort of asset subtype, which is occasionally exposed, to very large supply floods, right, which we're seeing in a few markets. But that really is the exception and not the norm. And to be honest with you, once this supply surge passes, and it's not being really replaced, the sort of normal sort of reality of the inability to expand housing supply will hit you square in the face. And by the way, there's some great work. We support Up for Growth. Just produced a housing report on its housing underproduction. There's tremendous. I think there was just a bipartisan council on a housing task force. They just released a general report, and all of them conclude, writ large, that it is a function of local impediments to the addition of supply and the increase in the cost of that supply, which is driving this. Now, it's built up over 40 years. It's really hard to unpack. We estimate you need something like 400 to 450,000 units of multifamily produced a year for 10 years solid to resolve the housing shortage, and that is just not going to happen.
Yeah, is that the number, Jeff? Because I hear anywhere from sort of like 2 million to 7 million units shortage.
But when you think
what
about
are
it,
you guys
well,
saying
again, it's about that. Okay, it could be 2 to 4 million units. Again, there's various different estimates, but we've also said, well, how many units would you have to produce to not only keep up with household formation and eat into this deficit over what period of time? And about 450,000 units a year over 10 years would be necessary. Now we have a supply surge going on right now in about 20 cities.
Right.
But when you get past that, you're down to 300,000 units, which is not doing it. And it's just, so you have a structural problem, right? And that's really where things are at. If you look at kind of like what is driving us, that's it. Okay, you can strip it. And now we can layer in. You and I are in this all the time. We can layer in other things that sort of either ameliorate it or make it worse. There's different nuances that we can go over: migration, reindustrialization. There's other things happening in the economy. All right, in terms of both immigration and all that.
Yes.
But we have an underlying problem which is structural in nature, which is not easy to resolve because it's local in nature. Okay, and that issue is what drives it at its core, and then there's other things that got layered on top.
Right. So in essence, what you're saying is between the onerous permitting, and of course, depending if you're in California or wherever, it could be more or less onerous, but it's bad everywhere, right?
Right.
Between onerous permitting, timeframes, cost of land, etc., the only new supply that's being built is really Class A plus, right?
Right.
To justify
the
rents needed. Yes.
Right. You kind of have let's say California, you have basically a barbell, right? If you're in the free market, right, you can only build very, very high end because of permitting, zoning, delays, uncertainty, plus just the cost of doing stuff, right?
Correct.
And the extra requirements added on. Or it's heavily subsidized, kind of light tech, income restricted, right? That's it. Nothing in the middle.
Right.
Nothing in the middle.
Yeah. So in the middle would be attainable workforce housing, which is why it's a great investment. But to your point, even we're feeling it now, Jeff, in some markets we're in, just because of the oversupply of new, where then it becomes very concession heavy.
Yes.
And you'll lose residents that sort of move upstream, right?
Yeah, and that will happen.
The C's go to the B's, the B's go to the A's.
Right.
And everybody gets diluted.
Let's say if we were talking about Austin or Charlotte or Raleigh, yes, you will experience that until this supply wave subsides. And you have to, if you want to go back to why did this supply wave happen in the first place? Well, rents grew, in COVID, rents grew 40% in all of these markets. Okay.
Yes.
And just to all be clear, right? The people who moved into them in the first year in 2020 and 2021, they improved their lives. They took, San Francisco or LA or New York or Chicago wages. They were able to move into these other cities. And even if rents went up, okay, they were better off. Now, where the consumer pain happened was in 2022 when the renewal increases flowed through. That's when the consumer pain happened, right? Because and renewals kind of came up to market rates. And by the way, it's taken this long to get that gap to close. And even in those markets where rents are going down for new lease trade-outs, renewals are still going up. Not by much, but they're still going up between 1% and 4%.
The demand, I think resiliency has been the story here. That's amazing, right?
Exactly. And again, if we look at
almost keeping pace with the crazy new supply we've had.
Well, in fact, when I look at absorption numbers, again, in these 20 markets that are the high supply markets in the Southeast, Texas, and the Mountain West, the units are getting absorbed. They are getting absorbed, like a 1.1 ratio, which is really quite good. Why are they getting absorbed? Because move-outs are way down. Why are move-outs way down? The increase in interest rates and the fact that most people in the single-family business, the single-family world, refied at 3% or 2.75%, they're not moving. Say single-family homes as a percent of stock, that ratio is way down compared to what it was, in pre-COVID. There was a surge of sales, obviously, in 21 and 22.
Yes.
And then as interest rates went up, so you don't have the movement of people out, and therefore there's less supply in stabilized properties. So that's how that new supply is getting absorbed. Not necessarily at prices that people would prefer they get. They are driving down rents. There is concessions among those units, but they are getting filled. They are getting filled, right? And to be honest with you, you know who's actually hurting in Austin? Believe it or not, it's the light tech deals. Light tech deals.
That's really interesting.
The light tech deals, because you can get a class B- asset that's actually priced less than the max net rents on a light tech deal with a lot less paperwork. And by the way, I mean, I service the affordable housing world too, and they're feeling that, again, it's a temporary pain. They didn't feel that pain in 2021. They're feeling the pain now. And again, it will subside. These things are somewhat transitory.
Right. So it's a cyclical phenomena in 20, 25 markets, but structurally, you and I know we're undersupplied by 4 million whatever units.
Yes. Again, there's different estimates of that.
It's not getting better. Right. And it's not getting better.
It's fundamentally not on a path to resolution. Let's put it that way.
Okay. Nicely put. So that's kind of where we are today with workforce housing, right? Let's talk a little bit about, as we saw, the peak was probably, better than I do. Maybe it was a Q4 21, Q1 22, somewhere.
Q1 2022. Yeah, early 2022.
Was probably the peak, right? Yeah. And so values are arguably down, depending on the market, 20 to 30%, I would say, in multifamily.
I've seen, I would say nationally, they were down about 20%, but they've kind of picked back up. So that values, again, on a national basis, are probably 13 to 15% below peak. Okay, and we are seeing transaction activity recover.
Picking up.
Yeah, mostly driven by folks who need a liquidity need, and they need to execute some kind of they have a liquidity need, the funds end of life, or they need a limited partner needs to go. So every deal that's getting done has a story. As to what,
or developer who maybe isn't leased up enough to get takeout financing.
Yeah, and again, there's select stress. It is very select and very kind of targeted. But you've got somebody who's got a refi. They bought at the peak. There was variable rate debt, and so there's slivers of stress. And I've seen it sort of most evident in Atlanta, quite frankly, and in like Houston. People who were syndicators bought at the peak. They're having some trouble. They're hitting a refi. They were variable rate debt. But again, it's a sliver. It's real, but one shouldn't take it out of context. Anyway, so when we talk about values, I would say that they may be under more pressure in certain markets that are very high levels of supply in the short term. So if you happen, again, to be in Charlotte, Raleigh, Austin, right, someplace it's going through a high supply, where you have variable rate debt, you have a loan maturity, or you have a construction loan that's maturing, there is some problems. But most folks, quite frankly, just said, if I don't have to sell, I'll just wait. But I would say, again, maybe we'll get to sort of valuations and interest rates in a second, right? We have to consider like what a normal interest rate looks like, right? And then therefore back into what is a normal effective cap rate at some level of stability, and it's not what it was now. So there is some sort of I think the entry points now are amazing. And remember, outside of these 20 markets, rents are growing 3 to 5%. In the Midwest, in the Northeast, in other markets in the West that aren't sort of heavily supply, rents are everything's going up 3 to 5%.
Mm-hmm.
Okay, so it really is depending upon where you look in terms of select situations.
Mm-hmm. But I know in one of your reports, I think you mentioned, I want to say I read 150 billion of multifamily debt maturities, and by the end of 2025,
That's
which
right.
seems like a pretty big number.
That's right.
And so, we've been talking, and I started the company in 2008, just so you know. So
Yeah,
I built this
okay.
company on a distressed platform, right?
Right.
And so we were looking, and when COVID hit, and then the peak values, and a lot of syndicators, like you mentioned, that over leverage short-term variable rate debt are definitely in trouble. And with the new supply, operationally in some of these markets, they're not hitting their performance or anywhere near, right?
That's right. I mean, there are. I mean, again, we've laid out within our service, like here's how you find the situations that are most likely to get into trouble. And then I also did a little bit of a retrospective where we took the deals that have gone bad and said, okay, what were the conditions under which those deals went bad? And it was very, very similar, right? They were bought late in the cycle. They're variable rate debt. They're in places where the fundamentals are declining primarily due to new supply, or they have a construction loan that's coming due and they're upside down. And there's about 5,000 to 7,000 of those properties that are potential candidates out of a stock of, let's call it 122,000 total properties. So,
there is a subset.
There's a subset, right?
But having said that, I guess, starting the company 2008, when there was just a bloodbath of lender foreclosures, we're not seeing that at all. Even the subset of distress that you're talking about, because now the lenders, for whatever reason, we could talk about it, they really seem to be sort of kicking the can down the road, right?
Well,
not willing to foreclose like they were.
I've had a lot of conversations with folks in the lending community. Okay, and it kind of depends upon the lender type. There are some lenders, particularly some debt funds, that while they did debt, they actually have an equity pool standing behind them, and they're just waiting to take the property. They're like, hey, this is cool. We'll just take it. Okay. So there's a couple of syndicators. When I looked at the debt funds they were with, then I talked to people at the debt funds. They're like, this is cool. Like, okay, we just view it as a different entry point. Great. Okay, so that's not your traditional lender. Okay, because they're really
they're a loan known sort of lender.
Kind of, right? So that's one group. The ones who are the folks who really do need liquidity are the commercial banks. And remember, there's usually about 2 years of extension on the construction loans.
Right.
And then, they really kind of want off the loan. They really want off the loan. So they are kind of pushing for a resolution. And there are takeouts happening there, either of the bank at par. The bank's like, hey, look, you can take the equity guy out. We're not taking a cut. We're just not going to do it. Okay.
We've heard that too. Yeah.
We don't need to. We're not going to. We think that there's a value eventually. So I'm happy to recycle our capital, but I'm not going to take an impairment. Go pound sand. Okay. But they would like to do it because they see the lending opportunity right now too, and they really want to recycle their capital. So they'd like to do that. But the other folks who maybe sort of like are having there's a bit of a sizing problem. There's plenty of preferred equity waiting out there to fill those gaps. So again, the lender is willing to say, hey, solve your problem. I don't want to, I'm not going to take a hit, quite frankly, because they're saving their dry powder for office. You got to understand it. Okay. There's a real structural problem in Class B office. And the banks are reserving and putting up their reserves against that exposure. They know that's the way they're going to have to take the hits. They don't think multifamily is a place that they're going to have to fundamentally take a write down. Okay. So they're happy to sell the loan at par. They're happy to sort of, close out the equity. They don't care about that. There are some that have deep relationships and are happy to work with the borrower, with the sponsor to recapitalize the deal. So there is, preferred equity out there to solve that sizing problem. But they don't see a need for a bloodbath in multifamily. I want to be clear about that. Not in office.
Well, and
office
to
is
your
a different
point,
story.
Yes. And to your point, Jeff, I mean, if nationally now we're only sort of 15% below peak, the commercial lenders are above water in almost every case in that regard, right?
Right.
As opposed to some of the debt funds or the arbors of the world, maybe that got aggressive at an 80, 85.
That's right.
Right. Maybe there's some impairment there. But, we're not even seeing those guys, right? They're all doing modifications, workouts, kicking the can, in my opinion.
Right.
But it's interesting on the commercial bank side because I have heard that, right? They know like, okay, multifamily, it's a bit of a temporary issue, but we have this looming giant, my office portfolio is going to be remarked at 40 cents or whatever the number is.
Right. No, it's again,
crazy.
Particularly if you got Class B office.
Yep.
They're going to be impaired, and they know it, and they've been reserving against it. And so for them, it's just a question of, have I built up my reserves enough over time to take the hit?
Mm-hmm.
Right. It's not a systemic bank risk. Okay. A systemic bank risk is when there's so much blood in the water that, like, the bank's reserves are at risk. That's not the case.
But do you think the banks are accurately marking those assets right now?
Oh yeah.
Because I've been seeing, and I'm sure you have, some unbelievable valuations on some deals that have traded in like urban metropolitans, the St. Louis's of the world, the Minneapolis's. Some of these Class B office buildings are trading for 10 cents, 20 cents, right? Just
they've already reserved against the loss. You got to understand, for them, it's all about, if they already built up the reserve, then it's like time to get it off your books. They'll delay it until they've built up the reserves to a sufficient level where they don't have to take an earnings hit or a capitalization hit. And so they say, okay, here's a set of loans that are going to be bad. Hey, we need to build up our reserves against it over time. They've been able to do that because there was a spread in the rates, and so they've been building up their reserves against that, and then they decide, okay, it's time to sort of draw down that reserve and take that hit, get it off the balance sheet. So they're being quite thoughtful as to in how they're doing this, so as not to create a systemic banking risk, systemic capital risk to the financial system.
Like we saw in 2008. Exactly. Which I don't think we're anywhere near
they're not, remember, because they're not being required to mark to market, right? Which is what got things in trouble. They're not even having to book their treasury portfolio to market. They're booked at par.
Which is a whole nother, correct.
Right. So what took the banks down in 23 when we had those failures was they were having to book their treasury portfolio to market. And then the Fed just basically wiped it away and said, we'll redeem it at par.
Right. Then you violate all your covenants and you're done. Right.
Right. So if you can redeem your treasury portfolio at par, you don't have a liquidity crisis.
Yes.
Which is what drove Silicon Valley Bank to now.
Yep. Exactly.
New York Community Bank, they got screwed because they loaned money against rent-stabilized properties that rent control has destroyed the value. That was a secular issue. There was no coming back from that one.
Right. And those are mostly small buildings in New York City, right?
Small buildings in New York City where the whole I'm from New York, if you couldn't tell. And that whole business system was based upon rent stabilization, 10% a year turns, doing a value add, marking it to basically putting it up to market. It was a beautiful business system, kind of run its own. It had its issues, right? Because of regulation and the problem with the housing market. The 2019 rent control bill killed that trade completely.
Yep.
It just takes 6-7 years for that problem to emerge. And those buildings are down 40% in value, and they are not coming back.
Yeah, no time soon, that's for sure.
And again, until the laws change.
Right. Hey, Jeff, let's shift gears here and talk a little bit about build to rent.
One of my favorite. I love that.
Okay, good. And I know you guys have been tracking it recently. I saw you're kind of starting to track it separately now and analyze it separately.
We've been tracking it separately since 2021.
Oh, have you? Okay, because I thought I saw a report recently where
we do kind of update market reports on SFR BTR as a separate segment, but we've been tracking it separately as a segment of multifamily housing since 2021.
So, and we've looked at some of these BTR deals recently. I think they're very interesting for a lot of reasons.
Yes.
I kind of wanted to chat with you about it and see what your take is, how you think they would affect traditional multifamily assets, like we talked about, affordability is a huge issue to buy a home.
Yes.
No one's selling a home because 60%, I think, of homeowners have a mortgage rate at 4% or less.
Me
Right?
too.
So me too. So they're locked in.
I refinanced the first month of COVID. Boom.
There you go.
Right
Perfect.
for it. Yep.
Yeah. So there's going to be more and more of a renter demand, I think, going forward. I think that's the argument. And I think I've also heard, does owning a single family home become almost like a luxury asset, unfortunately, for a lot of people, like it is in many countries around the world.
Yeah. We'll talk about that maybe separately, but let's just talk about SFR BTR. That is single family rentals in built to rent communities. Okay.
Correct.
And I want to just, before we even go to that, absolutely differentiate that between single family rentals, basically called scattered site. Okay. So scattered site rentals are your existing single family homes that are purchased and turned into rentals. They tend to be clustered. And again, I was in that business too on a separate platform. It's a great business. There's organizations that are now learning how to run that thing at scale, but it generally appeals to people who already have families and are placing and renting a home because they want to be in a certain school district, or that's the best school district they can afford to be in, okay, for their kids. The SFR BTR world, okay, is because of its nature, and there's 3 or 4 different subtypes within that, because you can have attached, you can have detached, you can have cottages.
Yes.
But the bottom, so there's different subtypes that are still emerging. We're tracking about 2,500 properties and 300,000 units, and that stuff, that asset type is growing quite rapidly. It was very, very little. It was maybe 100,000 units right around the pre-COVID timeframe. There were a few innovators in Phoenix, in Texas, in the Midwest. There were like 3 or 4 companies that really had pioneered this asset type, and it has kind of blown out. And so where is it being built? It's being built at the edge of metropolitan areas because the land has to be cheaper than in near term. So it benefits from the spreading of the population, and in metropolitan areas that have more hybrid work arrangements. That works out well.
Yes.
So it's at the fringes. It's in emerging school districts, so that you are not getting people who have school-age children. You're getting people who have pets. They are couples. They're retirees. They want some more space, but they don't need a school district, at least not yet. Okay.
So these are these are couples
pre or
before
post.
Kids or after. Yeah.
Exactly. And that was I had to pound it, to my clients, is like, hey, this is not scattered site SFR. It's not school district. That's not what the people are doing. They want more space. It competes directly with 2-bedroom suburban product. And you can look at the relationship, and it moves very, very much in sync with 2-bedroom product. Now, more of the 3-bedroom product is now being built. Less of the 1, more of the 2, and then we track that, what the unit mix is, and we're seeing more of a drift to 3-bedroom and higher of the new projects being built now. And it's really for folks who want more space. They want more space than a 2-bedroom, and they're willing to drive further out or be further away from shopping or commercial districts or downtown in order to accomplish that, and their lifestyles enable that. And that is much more true, kind of post-COVID. So it's an adjacent multifamily asset class. It's adjacent, of course, to single-family homes, and it fits that. There again, there's a clear consumer need for it. It's a new asset type. It's growing rapidly, but it's very, very small. I mean, again, in the larger scheme of things, so it is a niche. It's a niche product. I happen to love it because you can see there's a clear need for it.
Yes.
It's very clear. But there is a range of different kind of product. Many of them are like communities. They've got amenities, centralized amenities. They have services. It's great. Some are sort of townhomes that are not detached. So there's attached and detached product. I'd say in some certain places in the Southeast, they're truly single-family homes where there's no amenities. It's a neighborhood for rent. That's it. Okay.
Right.
So and the builders are coming at it from different perspectives and different heritages. So it's still a product type that's in flux, in experimentation. And I think Fannie just put out a research note on the SFR BTR segment using some of our data. Again, it's a niche. I love it. It basically fills a need. That need, I think, is quite durable. Over time, the school districts will build up in those areas, so it will become more appropriate for families with school-age children. But this first wave of residences and residents aren't that. But it will be. Give 10 years, then these areas will have built up schools districts, and then they'll appeal to a different customer segment.
Okay, so you think it has legs to run for a long time,
and
it's just going to carry sort of the younger couple to now a couple with little kids who are in the school district, and they're going to stay. I mean,
if they don't stay, then they'll attract new residents who do.
Yes.
Okay. And it does seem to have the same turnover relationships like single-family rentals on a scattered site, where the turnover rate is about 30%. The cost per turn is higher. On a sort of a turn adjusted on the P&L, it's about the same kind of turn costs of multifamily because you have fewer turns, but the cost per turn's higher. So it kind of, again, the economics kind of work out,
so
pretty
the
well.
Economics flush out. But I mean, if you're at 30, that's half of sort of a traditional multifamily turn.
Yeah,
right?
though we have seen traditional multifamily in this segment, okay, this last couple years, this year or two, where the retention our turnover has come down significantly because they can't afford the move out, right, to buy a home. But this is a good halfway house, right? Again, if your lifestyle enables you to be further afield, work from home, or at least work from home more often, let's put it that way.
Yes.
Then you can make it work.
For a hybrid work from home model, I think it's perfect for that.
And again, that may drift you I've been tracking hybrid work and work from home right out of the gate from COVID. And I haven't been surprised, but a lot of people have been surprised. Like I could tell right away due to demographics and the aging of the population that work from home and hybrid was going to have huge legs. And it really has broken out the way I kind of thought it would break out, which is, again, let's just look at office using employees, okay? A third, and totally breaks out by industry and by function. Okay. So there isn't a one size fits all thing here. It's really industry and function, and therefore the industry mix and the functional mix then have a differential impacts on different metro areas. Okay. So that's why the different metro areas are impacted by different ways. You have about a third of the workforce that is back in the office 4 to 5 days a week. They are primarily early stage tech, finance, and sort of like illegal but deal legal. Deal teams, not your general contracts. That's about a third of the workforce, 35% of the workforce. And by the way, there's a great data source here called the Flex Index, which is free. The company's up for sale, that have been producing this data on about 6,000 to 7,000 U.S. Companies. Best data set I've seen in this area at all, bar none. Best thing ever. Okay.
What's it called?
It's called the Flex Index. These guys are great. I've spoken to the guy who runs the company. Super guy. Really nice guy. Great data. Okay, just amazing. And so a third is in the office all the time. 20%-ish, call that 20%-ish, are now fully remote. These are specialized workers. Now that's up from 5%. Okay, from 5 to 20. And these guys are fully remote. They're specialized skills. They're just completely remote, and they are everywhere. Okay. They're in small towns, they're in mountain towns, they're in beach towns. They were in Lisbon and they've come back. Okay, but they're everywhere. They're just everywhere, and that's what's feeding a lot of the small town growth, the mountain town growth, the beach kind of growth, but not expensive, not retirees, but this sort of less expensive world. And then you have the rest of the population is hybrid at about 2.5 days a week. Okay. Particularly, and again, when I'm talking about office using employees, these are people who are moving information. Okay. That's what they're doing. They're moving information. And most of the people who are hybrid are executing stable processes, right? if a job function is chaotic, they're in the office. There's too much going on. Can't figure it out. That's why the real estate deal teams never left the office. They were gone for a month. They'd been in the office ever since. But most people who were sitting in an office, it really was an information factory. They were executing a stable process.
Mm-hmm.
Those people are most inclined to they fit with hybrid, and they spread all over the place. And that's where you've had movement of companies into the Southeast, right? From California, from New York, from Chicago, right? Into the southeastern cities. And then those companies, when they settled, yes, they got an office, probably smaller than the one they left, okay? And their employees are hybrid, and so those folks are spreading over the entire metro area. So, for example, we've expanded our coverage areas in major metros because of the spreading of this population. All the southern metros, we've picked up all the surrounding counties because people have scattered in search of lower cost housing because they could. All right.
The phenomena of Zoom calls and work from home and COVID.
Right. Again, it's very durable. It's very durable in the United States. It's hybrid-ish, 2.5 days a week. And please don't get distracted by some of the tech companies saying, hey, 5 days a week, you got to come back to the office. I mean, look, I love the folks who are office leasing, but honestly, that's a back-ended layoff. That's got nothing to do. That has nothing to do with the sort of core of work productivity. That is a way to fire people without having to go through a formal layoff and deal with the market blowout of that.
Right. It's like, oh, you 5 don't want to come back? Okay, sorry.
Gone.
We don't, right? Yeah.
Gone. And by the way, if you're that important, I'll make an exception for you.
Yeah. Although I think Jamie Dimon's been saying you got to get back to the office for a couple of years now. And
but I want to differentiate finance from tech.
But I still don't think it's even happening at his firm.
Yeah, it's happening more.
4 days a week, maybe.
It kind of depends on whether you're doing a deal or executing a stable process, right? Different function, different dynamics. Look, I will also say, just to be honest, I run a business which is basically executing a lot of the research we do has a lot of stable processes, right?
Mm-hmm. Mm-hmm.
We are a largely hybrid organization, my division personally, and our turnover has gone down by 2/3 because we are able to access and retain people, build their skills because we're giving them workforce flexibility. Now we can measure productivity very tightly, so we are getting as good or better productivity with much better retention and much better skill set because, again, it just so happens that my business has the characteristics that lend itself to that kind of working environment.
Yes,
it doesn't fit for everybody.
As long as you're able to measure and track and have accountability, it's perfect.
That's right.
It's a win-win, right?
And there is a role for the office, and there is a role for training, for socialization, for skill building, but it's not 5 days a week. It's a day or two, okay? And my company, as we've been rolling our leases, we've cut our footprint by 55%.
Wow. And I've been hearing that across the board, right? Major law firms, they're all cutting back 20, 30%.
But again, it very much depends. This is what I'm saying is, so do I think the overall reduction in office footprint's probably 20% overall, right? It's not like, because I'm not everybody. But for our business, for what we're doing, that works for us. So we now have, I run 3 offices within Yardy's network of 40 offices, and we have a schedule where all the teams have a schedule as to when they can come in the office because we couldn't accommodate everybody if they all came in at the same day. But everyone's on a schedule. It works. Everyone seems to be happy with it. Some people are on Tuesday, some Wednesday, some Thursday, and nobody likes to come in on Monday and Friday. That's when I go in. When no one's around, but it works.
I hope today's show inspired you just a little bit, and I would like to thank my guests once again. I'm excited to bring you more episodes with interesting and informative experts to help you navigate your way to wealth and health.
Thanks for listening to the Real Estate Wealth Podcast. The Real Estate Wealth Podcast is produced by Truthwork Media. Our producer is Seth Creekmore, with support from McKenna Smith. For show notes and more information about this podcast, visit edaloe.com. For more information about CalCap Advisors, visit us at calcap.com or follow us on Twitter at calcapadvisors.
I'm your host, Ed Aloe, and thank you for listening.